Welcome to module number 6, where we are going to explore the fair value measurement. Before starting this module, I would like to highlight also that we have another separate relevant accounting standard for the fair value measurement, which is IFRS number 13. And of course, because part of the financial instruments are being recognized and measured at fair value, so that's why you will find that we are going to explore the fair value measurement in alignment with the IFRS number 13. So before we start this module again one more time, I want you to get an understanding of how IFRS framework and how the IFRS are being interrelated. As you see, we are talking about IFRS number 7, and sometimes we are referring to IFRS number 9 because IFRS number 7 is all about disclosures about financial instruments. IFRS number 9 is all about financial instruments. And we are discussing now fair value, and we are going to explore IFRS number 13 as part of the fair value measurement. So as you see, several accounting standards are interrelated, and this is what you are going to expect and what you should expect at your exams. And also in real life, that one business case study will be covered under more than one relevant accounting standard. So what is the definition of the fair value as being defined in IFRS number 13? Fair value is the price that will be received if you are going to sell an asset, or you are going to pay if you'd like to transfer or settle a liability in an orderly transaction between market participants that are willing and knowledgeable about the asset being transferred. And this fair value is measured at the measurement date, not necessary to be at the reporting date. So fair value measurement is crucial for financial instruments. Why? Because it provides relevant information about an entity's financial position and also the risk exposure. So for example, imagine a company holds an investment in marketable securities. The fair value of these securities reflected their current market prices. And understanding the fair value of the financial instruments allows stakeholders assess the potential gains or losses that may impact the entity's financial performance. Now, when it comes to the techniques and inputs used for fair value measurement, IFRS number 13 outlines various techniques for determining the fair value, including market prices, recent transactions, and also valuation models. IFRS number 7 requires companies to disclose these details. So when it comes to the input to the fair value measurement, these inputs are categorized into 3 levels as per IFRS number 13. Level number 1, which is based on observable market data, and level number 2, which is based on observable market data but for identical assets, and level number 3, which is based on non-observable market data, and it's all about estimation using valuation models. So these 3 levels are being classified and are being sorted based on the observability of the inputs. So I urge you to please check IFRS number 13 chapter for more information about the fair value measurement. Another example for a financial instrument traded on an active market. So this will be level number 1. Why? Because we have trading and the public market prices and active market prices in active market for these financial instruments. That's why it's called observable market data. The fair value can be easily determined using quoted market prices for this type of financial instruments. That's why it's called level number 1, which is the most accurate and doesn't include uncertainty, because you can check this on the stock market screens even. However, for instruments with less observable input, level number 2 or level number 3, so entities here may need to use valuation model or other estimation techniques. So understanding these levels and input is crucial for accurate financial value measurement. And understanding these levels and inputs is crucial for accurate fair value measurement. So let's summarize what we have discussed. Fair value measurement is integral to the financial instruments reporting in order to provide the stakeholders with a snapshot an entity's assets and liabilities. The techniques and inputs used in the fair value measurement vary, and entities must select the appropriate methods based on the nature of their financial instrument. In the next module, we are going to explore the risk management objectives and the policies for this risk management. Stay tuned and join me in the next module.